Good morning, and welcome to the Hedge Trade Daily Risk Brief for May 27, 2026. Today we'll walk through the current market landscape, focusing on key structural themes and tactical risk considerations as we navigate the dashboards together. The U.S. equity market continues to exhibit a structurally bullish environment, supported by broad moving average alignment across the 10 to 200-day range on both daily and weekly timeframes for the S&P500 and NASDAQ 100. This confirms the prevailing uptrend remains intact. However, momentum indicators are beginning to show signs of short-term exhaustion as prices approach key resistance zones, suggesting elevated risk of consolidation or tactical pullbacks. Volatility remains moderate, with the VIX currently at 16.29, reflecting a stable but increasingly sensitive market backdrop rather than outright risk-off conditions. Looking at the S&P 500 projection framework, the index is testing resistance near 7,550, while short-term indicators including the Hull Moving Average, MACD, and Commodity Channel Index are signaling potential for sideways consolidation or retracement. The broader structure remains bullish, but a pullback toward the 7,400 support zone would likely provide a more attractive risk-adjusted entry opportunity. Turning to the NASDAQ 100, the index continues consolidating around the psychological 30,000 level, following a sharp recovery from recent lows. Daily momentum indicators are cooling, while weekly momentum remains supportive, suggesting the market may be transitioning into a digestion phase, rather than preparing for an immediate directional breakout. From a broader risk perspective, current volatility and liquidity conditions remain consistent with tactical consolidation rather than systemic stress. Key support levels on the S&P 500 remain 7,400 and 7,300, while resistance is concentrated near 7,550 and 7,600. Holding these support levels is important to preserve the structural bullish trend. For the NASDAQ 100, support is centered near 29,200 and 28,500, while resistance remains concentrated around 30,000. From a portfolio positioning perspective, the current recommendation remains to maintain equity exposure, but with increased tactical discipline. Chasing extended moves near resistance is not favored at this stage. Instead, patient pullback entries or confirmed breakout continuation setups offer a more favorable risk-reward profile. In summary, U.S. equities continue to trade within a confirmed structural uptrend, supported by broad moving average alignment and higher highs and higher lows across major indices. However, near-term momentum conditions suggest increasing tactical caution as markets approach important resistance levels. Thanks for watching the Hedge Trade Daily Risk Brief, and I'll see you tomorrow.